All right. Well, good afternoon, everyone. Charlie, I think we're live. We got the countdown. Everyone's here. How you doing
Awesome.
today?
I'm doing awesome. Happy New Year, everyone. I'm still going to throw that in there because it's still January.
This is your
Great
last
to have you.
chance. Next time we
Your
get you
last
on, you
chance.
can't
That's
say
it.
Happy New Year.
Yes,
You'll have to say
that's
something
right.
different. You have to be more creative.
Exactly.
Well, Charlie, thank you for joining us. It's great to see everyone or have everyone join us again for our quarterly installment. We got you early this time, so I feel like we did this recently back in December, but so much has happened since then. We had to get you back, so I'm
Absolutely. Yeah,
excited to talk
same.
through things with you. I guess for anyone that still doesn't know Charlie, you should definitely follow Charlie on X, as well as the Creative Planning YouTube channel. I think you said is a good spot to see a lot of your content and of course your blog. I will throw a couple quick housekeeping items in here right now too. First of all, as usual, YCharts is not acting in any advisory or nothing that we say today is going to be a recommendation, so don't think of us in that capacity. We're here for entertainment and educational purposes. Also, if you want a replay of this webinar, we'll send that around to everybody that registered. But you can also catch a replay of this as well as all of our other webinars at our new webinar library, which you can access via our website, just in the menu at the top and click on that, and you'll see all of the content that we get out regularly as well. And lastly, if you have questions as we go through the great content today, please feel free to type those into the Q&A module there in Zoom. And Charlie's promised that we're gonna get time to answer those today. So we will get
Let's
to
do it.
those. All right. Well, we've got a great agenda today. So we're talking about the everything reversal, and based on the way the market's been going, I'm going to guess that's a good reversal. Also going to talk about markets not moving in straight lines. We'll talk about the Fed as we usually do. At least touch on that. We've got a whole section on gold this time. So excited to get into that. Charlie's favorite topic, and then we'll talk about some of the most important charts to watch for 2026. But we've got a lot to cover, so let's go ahead and let's jump in, and we'll start with the everything reversal. And Charlie, this is kind of a pickup from a conversation that we had, I think a few years ago. We touched on this topic back in like 21, right? When we started to see some movement in the charts you got here.
Yeah. And the big question, Caleb, this is for investors, asset allocators within the equity market. We know what the big secular trend was for 15 plus years. We saw US outperforming international, large cap stocks within the US outperforming small caps, and growth stocks led by the Mag 7 outperforming value stocks. So this is up till 2024. These are what the trends look like, and you can see, various lengths here, but US versus international is the longest period of outperformance in history. It was 16 plus years entering 2025.
But
But if we look at these charts now, we're starting to see a little bit of a reversal. It started with international pretty much from day one in 2025. We saw international stocks start to outperform US stocks. They actually had their best outperformance versus US stocks since 1993. But what we didn't see in 2025 was a reversal in the other two major trends here, the large cap versus small caps. Small caps still underperformed last year, and growth versus value. Value underperformed by a little bit. But so far this year, Caleb, all three are reversing here. We're seeing outperformance in international, small cap, and value stocks.
Charlie, just want to quickly touch on this chart, right? So these are ratio charts. They're built out. Are we just looking for the trend in the chart here, or does the nominal value also all matter?
Yeah, nominal value can ignore just the trend, and it's basically when US is outperforming, you'll see that line rising. When large caps are outperforming, you'll see the line rising, going up and to the right, and same thing for growth versus value. So it's really just the trend, and taking a bigger picture look at this is the real important thing, which we'll show in a little bit in terms of giving it context. But
So here we've got a table though, kind of explaining, yeah, specifically, I guess, looking at large caps versus small caps, and everyone kind of always associates small caps with a risk on trade or something that should perform better when the markets are going up. That hasn't really been the case though, right?
Yeah, that pattern definitely broken over the past decade. It was broken also in the 90s. Right? You definitely saw a similar pattern of large cap outperformance led by growth stocks, led by tech stocks. So very similar to what we saw in the mid to late 1990s we've seen over the past 5 years. In fact, it's the only other period other than the last 5 years where we saw 5 straight years of large cap outperformance was during the 90s there from 1994 to 1998. And if you look at that table closely, what you'll see, Caleb, happen next is a reversal where for 6 straight years, small caps outperformed and by a pretty good margin. So the question is, are we going to see a repeat here? And if you just pull back and you look at that small cap outperformance, underperformance, it's very similar to what we saw during the 1990s. And the ratio of large caps to small caps almost got to a record high. It got back to its 1999, very close to the 1999 peak last year before reversing and moving in the other direction.
Right. So, looking this year, we have a big outperformance, right? And you can also see, a few of these other classes here. You know,
Yeah, it's pretty much everything. So small caps leading the way up close to 8%, international stocks 5%, value stocks up 4%, S&P still up on the year, up 1%. But you see growth stocks there actually down slightly for the year. And again, it's only a few weeks into January, but I think this is meaningful given the extremes that we were at with all of these asset classes. So we're seeing continuation of the international stock outperformance, but now in addition to that, we have small caps and value joining the party. And the big takeaway for investors is diversification is finally starting to help portfolios. It definitely helped last year if you had international stocks in your portfolio. Now you're seeing some benefit of diversifying within the US outside of tech and growth and the Mag 7.
yeah, you don't have to look far back, Charlie, to see. One of the questions that we heard a lot, and I'm sure you did too, is why wouldn't I just buy the S&P 500, right? What could be better in my portfolio than just owning, that index or that ETF?
Yeah, no, there's only one good answer to that, and it's that there's a cycle to everything, and there's a chance that the S&P won't always outperform. And if we go in the opposite direction, we have a long cycle of the other stuff outperforming. Well, then if you have that in your portfolio, you'll obviously be happy you did, but also will help you stick with your overall asset allocation in the long run. So that's the real reason for diversifying, Caleb, is because we don't know. Like if we knew that the S&P would continue to lead, we would put everything in it, but because we don't know, we have to have these other asset classes to protect us in the event that there is a reversal.
And I mean, so much of that S&P performance, over the last few years has been driven by these huge companies, right? The Mag 7, before that we were talking about FANG and all the other acronyms. But I like what you did here, right? We've got kind of two magnificent stocks at this point.
Yeah, because you're still hearing people talk about it, but really over the past year and a month now, it's really just been Google and Nvidia really outperforming, and the rest of the Mag 7's actually underperforming the S&P 500. So this is very different behavior than what we saw in 2023 and 2024, where all of the seven were outperforming the S&P by a wide margin. So we're starting to see investors kind of differentiate here, saying who will be the AI winners, and so far it's betting on Google and Nvidia, but of course that could change. And I just think overall the picture is becoming a little bit more fragile in terms of these names. We've talked about valuations. Many of them at the start of this underperformance were more highly valued than the market. And now we're seeing kind of investors question the growth rates going forward. And to me, this is just another thing to look at in terms of looking at that growth versus value and U.S. versus the world because of the high weighting of these seven stocks within the S&P 500. It's about a third of the index, Caleb, is in just these seven names, and that's a record in terms of there's never been just seven names in the S&P 500 representing such a big weight.
Yeah, I was going to ask you that, Charlie, right? Because you look at these stocks and they comprise such a huge amount of the index. It's hard to avoid them, right? And you see a chart like this and you say, should I be actively moving away from some of these names? Should be looking at some of these products that are like X Mag 7 or even like equal weighted indices? What do you think about some of those approaches?
Yeah, and my statement to that is similar to what we said a few years ago. I wouldn't want to exclude them because the run could continue, and certainly this is where the earnings growth still is until proven otherwise. So I wouldn't want to exclude them, but I wouldn't want to just own them. And so the best way for diversified investors to think about it is simply if I own everything, then I don't have to worry about picking the winners and losers. And I think with AI, it's just going to be even more difficult to pick who the ultimate winner is going to be in this race.
And one of the concerns around diversification, right, is whenever the epiphany happens and you're like, oh, I should have been more diversified in my portfolio, it's too late, right? And then you're chasing returns and you're taking that kind of famous investor behavior, which is buy high and sell low. And yeah, how would you think about that mentality when you're looking at a portfolio right now?
Yeah, so it's fascinating because we're getting questions from clients asking, is it too late? International had such a great year last year, which is interesting. They're asking that because a year before they were saying, why should we have international at all? Now it's, should we keep it? Is this too much? And just giving you longer term perspective here. Yes, we've seen a mean reversion, but it's nothing to write home about given that enormous period of outperformance. Same thing with large cap versus small caps. You can see we're still around the levels we were at 2000 in 2000 during the dot-com bubble peak, and same thing with the ratio of growth to value. That's not to say we're going to see what we saw following 2000 exactly. I expect it to be different. It's different every single time. But if you're just asking yourself, could there be more in terms of this run? The answer would be absolutely there could be. We haven't seen very much at all just yet.
And this next visual, I think, makes it even more apparent, right, that there is absolutely room for reversal and kind of a sustained one, right?
Yeah, and this is what people will point to if you talk about the international outperformance. They'll say, "Well, just what about the last 5 years? What about the last 10 years? What about the last 15 years?" And yes, the answer is the US is still crushing international stocks under those time periods, but I wouldn't use that as an argument not to hold international stocks. You don't want to wait until international stocks are crushing US stocks over 5, 10, 15 years before you start including them in your portfolio because now you're missing out then on those potential gains. So on a rolling 5 year basis here, it's 15 years still of US outperformance, which is by far the longest in history. You could see the previous record was in the 90s into 2000. It was 12 years. So this is just another example pointing to that. Yes, it's been a huge international run versus the US, biggest we've seen in over 30 years on a 1 year basis. But if we're looking at 5 year period, 10 year period, we really haven't seen very much of a reversal yet at all.
And we can look at the fundamentals too. You mentioned a lot of the earnings growth is coming from those big U.S. names, but it's a lot of that's already priced into the market, and there's huge premiums on those right now, right?
Yeah, this would be the case. I think you say, well, what's the argument in terms of should there be continued reversion to the mean? Well, you just look at the valuation spread between US and Europe. We entered 2025 at a record spread. The CAPE ratio in the US was almost double what it was in Europe. The spread's narrowed a little bit because of the gains in Europe last year, but not, you could still see it's pretty wide. You still have a European CAPE ratio around 22, and China, which is still the biggest EM weighting in most of the EM indices and ETFs, you're down at 17. And you can see historically, Caleb, it's not true that always the US is trading at such a wide premium. In fact, this is really the widest we've seen. And so investors will ask, well, isn't this justified? Because US growth stocks and US in general has seen better earnings growth than the rest of the world. And you could say maybe that is, but only if you believe that growth rate spread will continue going forward. Because if it doesn't, if we start to see that narrow, then you're likely to see a narrowing in these ratios, which means that you could have potentially years of outperformance from outside the US. So let's say if the CAPE ratio in the US were to mean revert and come down, while these other areas were to go up, you could see potentially it could take years to close this type of spread. And it doesn't even have to close, I would say. Let's say you think 10 years from now the US is going to be as highly valued as today. Well, then what I would say is, okay, what's going to happen with the rest of the world in terms of their valuation ratios? And then you lost your argument, Caleb, for the US showing significant outperformance because a good portion of the US spread in terms of performance over the last 10 years was multiple expansion, right? So if you're not going to include that, you're going to say, yeah, U.S. stocks are going to hold their multiple. Well, now you don't have that justification for further U.S. outperformance. So even if let's say the performance is all the same, you're still going to have a benefit of having other stuff in your portfolio because it's not going to be moving in tandem all the time. You're going to get that diversification benefit because sometimes the U.S. will outperform, sometimes Europe, sometimes emerging markets, etc.
So regardless of the direction or what happens to multiples, expect these gaps or the spread to close a little bit. But how much of this trade too is dependent on some of the macro, like global political tensions, and do you think about that, or can you look at this purely from a fundamental standpoint and get comfortable with changing allocations without having a opinion or position on where some of the global trade and political tensions might be?
Yeah, I think all that stuff, Caleb, is too short term for an investor to kind of think about. And I think last year would have been the perfect example of if you told people at the start of the year we're going to have tariff rates in the U.S. going up from 2% to 14%. You're going to have trade wars and all of this tensions, and the U.S. potentially is going to import fewer goods. People would have said, "Yeah, that should hurt stocks and companies outside the US." That didn't happen. The exact opposite happened. So the markets are always forward looking. The markets can look past a lot of things that seem important in the short run because in the long run, it just comes down to earnings. And if earnings aren't being impacted by all of those concerns that you talked about, well, the market's going to look through everything else at a given time, and it's going to push higher, right? If there's strong earnings growth in these corporations, whether they're in the U.S., Europe, and China, it's going to be hard to push them down. And I would say it's only a question of, well, how big is that growth relative to expectations? So we know within the U.S., the expectations are still very, very high for earnings, as we'll talk about in the last section. And the rest of the world, I would say the expectations are still much lower. So really, valuations, Caleb, are really a reflection of sentiment, and the sentiment in the U.S., even after 2025, is still much, much higher. People are much, much more optimistic about the U.S. than the rest of the world. And that's a
And
good
do you,
thing if you want to diversify outside the U.S., in my view.
yeah, I guess like thinking about that same line of thinking, we talked about, some of the geopolitical things happening, but also the US dollar, right? I guess you said, hey, if margins are going to, expand or, the valuations are going to change, in parity across different regions, you still have the currency conversion that could play a factor there, right? So
Yeah,
how are you
and the
thinking about that?
currency has not been a small factor. The U.S. dollar, as we'll talk about in the gold section, had its worst year in a long time last year. It's down even more today as we speak. It's hitting four-year lows, and that's helpful for U.S. investors that are investing internationally, assuming they don't hedge out their currency risk. They're getting the benefit of the euro and these other currencies appreciating. That's an additional benefit on top of their equity markets being strong. So it's just another reason to diversify is because you can have these swings in currencies. And hopefully, as an American, we want the dollar long term to be strong, but it's been 10 years with speaking of secular trends, the dollar has been strong for a very, very long period of time. And last year we saw a reversal. We've seen plenty of periods where we have multi-year relative weakness in the dollar, and that could happen. And if it does, it's going to be an additional benefit for U.S. investors that are investing internationally.
All right. All right. Well, let's jump into our next section here. Talking about how markets move, and it's rarely in straight lines, and it's rarely, predictable despite all the averages that we see. But this is a similar visual to one that we talk about a decent amount, but there's always something happening, right?
For sure. And there's going to be more. We can fill in this We're going to be filling this in
We're going
throughout
to have plenty of lines to add
2026.
here. Yeah.
Yeah, I mean every year is different. You can have multiple corrections, you can have different sizes and corrections, but you know something's coming. We just don't know when. We don't know how big it's going to be. And because of that uncertainty, Caleb, that's why you're getting the equity risk premium. If we knew for sure how big the correction was going to be, how long it was going to last, when it was coming, the equity risk premium wouldn't be as high as it is. The average year has 3 to 4 corrections over the last 100 years, 3 to 4 corrections of 5% or greater. Last year we had only two, but one of them was a bear market, pretty brief bear market, but a 20% plus decline nonetheless. How big is it going to be this year? The average year sees a reasonable decline, so I would expect it's coming. We just don't know when. It's probably going to be a different reason, something that's not on here. Maybe it could be tariffs again, but you could point to any number of things today that people will say in hindsight that's the reason why stocks are falling.
Charlie, do you find that just based on exactly what you said, right? There's been a lot of these 5% or more declines, but lately we've seen things turn around and come back pretty quickly. Do you feel like investors are becoming, I guess, more willing to take that risk on because they expect that recovery to happen so fast? Is it changing investor behavior from your perspective?
Yeah, for sure. That's the buy the dip mentality. And 2022 was reasonably long. The bear market, it was 10 months, 27% decline. So not, but other than
Ancient
that,
history.
yeah, ancient, right. People have forgot we had 3 straight strong years after that. So definitely people have forgotten that. But for sure, this period since the March 2009 low, there's 31 of these corrections greater than 5%. But many of them, the recovery was V-shaped. Many of them, the recovery was pretty quick, and you soon forgot about the reason for the pullback to begin with. But I think the big lesson in terms of this visual here is the S&P 500, including dividends, is up 1,300% since the March 2009 low. And we have 31 of these declines, with some of them very scary reasons. You have debt crises, you have pandemics, you have the tariff situation last year, you have the highest inflation rate since the early 1980s. But if you stuck with it, if you were able to withstand that short term pain, the reward was tremendous, 1,300% gain. So there is no upside without that type of downside. There's no reward without risk, as this next visual illustrates.
Yeah, I mean, this one's really interesting, right? Because it shows even in these big up years, we've seen huge drawdowns in those same years, right?
Yeah, which is remarkable. And again, last year, maybe people forgot if you weren't paying attention to the markets in February, March, April last year, especially early April, you probably very quickly forgot about that because the market had a V-shaped recovery. But we had a 19% drawdown on a closing basis. It was actually pretty similar to 2020, though the decline wasn't as big, where we ended the year up 18% in both of those years, yet we had big drawdowns. And that's happened many times. That's not unusual. Comebacks are very common in the stock market. And if we look since 1980, the average intra-year drawdown is 14%. And if that came starting today, Caleb, I could tell you all this history and I could tell you the market's done 12% a year since 1980, which is above its longer term historical average of 10%, but you'd still be freaked out. You'd still be scared because you don't know that it's going to stop at 14%. It might not, right? And
Right. And you
that's
see examples of that here too, right? It doesn't, in fact, I guess we'll get into a slide in a couple slides that show, rarely do those averages hold up, but, um, even this one, right? Like we talk about this a lot of times at the beginning of the year and everybody knows what's going to happen, right?
Yeah, for sure. Especially the strategists on Wall Street, they're very confident in their predictions entering the year. You have to be. You can't be wavering. You can't say I have no idea where the S&P 500 is going to end the year. Nobody wants to hear that. But if we look at this year, what's interesting to me is a few things. Number one, they're after 3 straight great years for the stock market, Caleb. They're expecting 11% gain, and that's the highest we've seen in a few years. We did a show a few years ago where they were expecting a down year on average for the market, which was extremely rare, and then we had a strong up year. That was, in 2024. They were expecting a down year. We ended up having a very strong up year. Market was up 25%, but here 11% gain, and I don't fault anyone for assuming it's going to be right around the historical average gain of 10%. But I think based on history, the odds of that actually happening are pretty low.
Right. So despite the average being 10% or so, we more often than not see numbers, way north of 10% or, way south of that, right?
For sure. If markets moved in a straight line and they gave you that 10%, that would be awesome. I mean, sign me up, sign everyone up. Doesn't happen that way. The average up year since 1928 for the market is a little over 20% gain for the S&P 500. The average down year is about a 13% loss. So you're more likely to have a big up year or a decent sized down year, much more likely than that 10% gain. In fact, only 4 out of the last 98 years did you come within 2% of that 10% return. So meaning 8 to 12% ending the year for the S&P 500. So don't be surprised if it's lumpy this year once again. Could we get to that 11%, 10% gain? Yeah, of course. I'm not ruling that out, but history has shown us that you shouldn't be surprised to have these. And I think that's just a reflection of how important in the short run investor behavior, investor sentiment is. So we get either very excited or you get pretty despondent. And so we either have down years or we have very strong up years. Oftentimes our sentiment isn't just neutral, let's say, to get to that 10%. That's my best guess at why this situation presents itself.
So speaking of best guesses, then Charlie, I guess the question is: are we going to be up 20% this year? Or are we going to be down 13%?
No idea. Well, the market's up on average 3 out of every 4 years. So we just had 3 straight up years. So if you think that the markets are due and it's going to follow that pattern, unfortunately, if you look at the history of returns, it doesn't. You can have 10 straight up years. We had 3 straight down years in a row, 2000, 2001, 2002. So even that is not orderly. So
Yeah.
no
Well,
predictions
it's
here
also
in terms of where the S&P 500 is going to end the year. My only prediction is it's going to be a volatile ride between here and the end of the year.
Yeah. I mean, it's interesting. We always look at these things in calendar years too, and obviously that's a clean way to organize the data. But so many of these trends carry, on throughout the end of the year, and then maybe reverse in the middle of the year, and that carries on for a while. So it's
Yeah,
the sentiment changes, more often than the calendar does. But
for sure. Yeah, and if you looked at just rolling 1 year periods, it would show a similar pattern. You're not often at that 10% level.
right. All right. Well, let's move on to the Fed. Charlie, you're still not a voting member of the Fed. We're
I-
we're
I'm
working on getting you
trying.
there.
I'm
But
definitely not going to be Fed chairman based on my
although it seems like the
commentary.
job's open, but
I'm not saying the right things. I'm one of the few hawks out there that don't believe we should have been cutting rates at all, and certainly don't think more easing is necessary today. This is just a backdrop of what the Fed has done in the past few years. Of course, we had the fastest rate hiking cycle in history not in history, since the early 1980s. In 2022, 2023, the Fed hiked 525 basis points in those 2 years to try to attack that spike in inflation to 9%. And then the last 2 years, we've seen a gradual, somewhat orderly easing here: 100 basis points in 2024, 75 basis points in 2025. And here we are, we're in a new range of 350 to 375. And the question is, well, should they keep cutting? And there's two camps, right? There's the administration, the president thinks rates should be much lower. And then there's many of the other people saying, let's wait and see. Inflation's still a problem. We don't have signs, as we'll talk about later, in terms of the labor market's pretty confusing, but we don't have signs of a recession or economic weakness that would call for lower interest rates. So I think it's going to be a huge fight at the Fed this year.
You said inflation's still a problem. So, I mean, we're seeing better numbers routinely kind of come through for inflation. Talk about the problem that still exists.
Yeah, a lot of people. This is confusing because of the terminology, right? People, and including the Fed, like they're the main reason why this is confusing. They just look at inflation as the last year, and pretty much they say ignore all other time frames. We only care about the last year. That you know that would work if inflation was orderly and going up 2% a year. Then who cares what happened before it? But as we know, the last 5 years we've seen an abnormally high rate of inflation. If we look at U.S. consumer prices, they're 24% higher than they were 5 years ago cumulatively. And that's 4.5% per year over the last 5 years, more than double the Fed's 2% target. Producer prices 4.7% per year. So inflation's come down to 2.7% if we look at CPI. That's the last year. If we look at PCE, which with what the Fed likes to look at, core PCE, it's at 2.8%. That's great that it's come down to that level from much higher levels, but I would argue they haven't got to 2% on the 1 year basis. And if you look at any longer time frame, we're nowhere near 2%. And it's the cumulative rate that matters to people, right? If you have in year one, prices go up 2%, let's just take the extreme. In year two, prices go up 100%, they double. And then in year three, prices go back to 2%. The Fed would argue inflation's 2%, but you can't ignore that 100% increase. And in this case, you can't ignore that above average period if you really care about inflation. So I think my view is the Fed should not cut interest rates any further until these longer term averages go down, get closer to that 2%, or they have to change their target. And to me, by cutting interest rates as aggressively as they have in the last 2 years, it's an admission that they don't really care about inflation. They care much more about the short term, and they have a bias towards easing. And this is an admission that the 2% inflation target is just words. You could throw it out the window.
Yeah. It is moving slower though than expectation. I know, we were talking, probably a year ago, expecting more cuts last year than we saw last year. And, if you look at a curve like this, expectations for Fed rate cuts are, I guess the expectations are lower for fewer cuts than they were. Um, is that making you feel better?
Yeah, I think I would like to see this line flat, like no expectation. But the market, what's interesting is the market's pricing in 1 to 2 cuts this year, with no cuts until June or July. And as a lot of people know, Chairman Powell's going to be leaving that position in May. So what the market's essentially betting here is that Powell's not going to go out with another rate cut. And you can read into some of the reasons for that. You can take him at his word. The Fed's going to meet tomorrow. There's no chance they're going to cut interest rates tomorrow. There's a 98% probability that there's no change. And I don't think they're going to cut likely in the two meetings, his remaining two meetings. Obviously, a lot of tension between him and the president. The president pretty much every other day is lobbing a new insult at Powell. I don't know how he can come up with any new ones because he said so many different things about him. They're doing a criminal investigation on Powell. Clearly, the pressure is we want lower interest rates. And he's been doing that. This is the interesting thing. He's been lowering interest rates. He lowered them last year. He lowered them the year before, just not fast enough. And I think this is where he holds the line, just in case, right? Just in case inflation starts moving in the other direction. I don't think he wants to go out by doing rate cuts that really aren't necessary, not warranted, in my view. And the data would back that up. If you're just looking at what I showed you in terms of the longer term inflation averages, there's not a clear reason to ease policy here.
So Powell's going out, someone else is coming in. I guess here you're seeing some of the different, possible next Fed chairs. I guess the expectation though is that these cuts will come once the seat changes over.
For sure. And this is the first time I can remember this is like a clear, open, and obvious and blatantly obvious litmus test for who's going to be the next Fed chair. They have to be publicly saying that they're going to call for much lower interest rates. And we've seen that with Reeder, with Warsh, with Waller, with Hassett. Reeder's now in the lead, but I don't, not sure it matters very much who it is because the president has said he's only going to nominate someone who's told them explicitly he's going to call for much lower interest rates. Obviously, if you want an independent Federal Reserve, that's not a good thing. I don't believe the Federal Reserve should be setting interest rates, but the only thing worse to that than that, in my view, is having the president or Congress setting interest rates because they're always going to think short term. They're always going to err on the side of debasing the currency because that will get them or their party reelected in the short run. So the market should be setting interest rates, but absent that, you shouldn't definitely shouldn't have a politician who wants to get reelected. They're going to say cut rates to zero, right? Why not? It's going to be
Sure.
good in the short run. It'll provide all else equal an economic boost. Who cares about inflation? Let's just juice things in the short run. So I don't think this is a good development. But my prediction, Caleb, is whoever he nominates, he's going to be frustrated with because there's 12 voting members of the Fed, and this is just one individual. There's going to be many other individuals which he can't remove that are going to be voting not for significantly lower interest rates. I say that's likely because if we just look at the Fed's dot plots that they did in December, they do this quarterly, essentially projecting where they think interest rates are going to be in 2026, 2027, 2028, longer run, you could see not many people are below 3% for 2026. So that could change, right? As the data change, this will change. But here and now, it's going to be a fight between that new chairman. Even in June, the market's betting that they will get a cut in then, but it's going to be a fight between that individual and the other members of the Fed. I think you're going to see the most probably dissents and division within the Federal Reserve that we've seen perhaps ever.
Well, we'll definitely be keeping an eye on the Fed. I know it's a topic we always come back to. Like you said, tomorrow's meeting is probably going to be pretty predictable, but as the year goes on, we'll be talking about that. Let's shift gears here, though, and we're going to talk about the golden age for gold investors. Talk about gold, and Charlie, I think as we get into this section, we're actually going to launch a poll for everybody that's on the webinar right now. And I don't know, I'll let you introduce it actually. We got four different asset classes to choose from here, right?
Yeah. So we just wanted to get a gauge of sentiment here. What do you think will be the best performing asset over the next year? Gold, S&P 500, Bitcoin, or cash? Cash meaning, let's say, 3-month treasury bills.
All right. So we will leave that up for a few minutes. And while it's up, I mean, gold's been winning, right? So what's been behind that?
Yeah, so a lot of factors we can point to. And gold, more than anything else, is a story driven asset class. You have to have a compelling story behind it, right? There's obviously no cash flow, no underlying fundamentals. It's driven by sentiment and the story. And the story, of course, given gold's performance, has been a pretty good one. And I'd say there's just multiple factors that we can point to say these are the different explanations or reasons why people have been more aggressive in buying gold. Number one will be the Fed. And pretty much every time in the last 2 years that the Fed has cut interest rates or talked about they need to lower interest rates, you saw gold take another jump higher. It loves unnecessary easing. It loves unwarranted easing. It loves an easier Fed that's essentially saying we don't care about what's going on in the currency. We don't care what's going on in inflation. We're just going to ease monetary policy. So I'd say that's been a big factor. Number two, you can't ignore the government deficit and rising national debt when it comes to gold. If you talk to any gold investor, Caleb, this would probably be the number one thing that they talk about. the fact that we're still running $2 trillion deficits. We added over $2 trillion to the debt last year, 38.5 trillion. We're going to hit probably 40 trillion this year. So that situation, of course, is a bullish story for gold because it means essentially you're borrowing from the future to spend money today and you're debasing the currency. So the debasement trade, Caleb, the dollar's down 11%, 2025, 2026, but the bet for people buying gold is that it's going to continue to go lower, and a weaker dollar, you tend to see a stronger gold market. And then you just have supply demand dynamics. The fact that central banks, they were net sellers for many years. If you look 20 years ago, they were unloading their gold. The last few years, we've seen a complete reversal, record amount of buying. Central banks around the world, 4,000 tons since the start of 2022. And then just uncertainty, even though, and this is what's confusing to people because they often think that gold is like the end of the world trade, so it can't do well when the stock market's doing well and the economy is in an expansion. Not true. If you look at the history of gold, it's just uncorrelated, zero correlation. Doesn't mean negative correlation. So there's been plenty of periods where gold and the stock market have risen together and both fallen together. And so really not as unusual as people think, but I think just every time there's some type of uncertainty, we saw it last year with the tariff situation, the trade wars, and gold would get a bump. It just, you saw, and it didn't give it back. And that's the interesting thing. Like the tariff threat would come, gold would rally, the stock market would sell off, and then the tariff threat would be pulled back or reduced, and the equity market recovered, and gold went up even more. So any of these, all of these different, any type of uncertainty, obviously, every day we have a new headline in terms of that. That's good for gold. And then finally, this is the most important one, and it's hard to kind of quantify this in terms of its importance, but momentum is a huge factor in the gold market in both directions. And after its strongest year since 1979, last year was up 65% in 2025. You're going to have people piling into that, and it's already up over 15% so far this year.
So I think, 65%, that seems like a massive move, I guess. Just how historic of a uptrend are we in though?
Great question. So I just looked at it right before I jumped on here, gold and silver. And this is just showing you gold, but I'm going to give you the stats. Over the past year, gold's up now 83%, and silver's up 245%. And if you look at the year over year change in gold and silver, that hasn't happened since the 1980 peak. So we're talking about 45 years since we've seen a move in gold and silver this big on a 1 year basis.
Anything to explain the silver versus gold?
So when you get these parabolic moves in gold, you tend to see the risk on trade, the momentum. Silver is more volatile. People gravitate towards silver. It's the more volatile asset class. It can be moved quicker in terms of demand, and you just tend to see the silver outperform in the later stages. Doesn't mean we can predict like a top by any means, but we saw that in 1979 to 1980. We saw it back in 2011. See, gold had a pretty good run back then. We saw silver spike, and then there was a drawdown following that. But you just tend to see that in the later stages of the cycle, people taking more risk, and silver is the preferred asset. But this is showing you, Caleb, gold versus inflation. And the number one people talk about in terms of gold, why do you hold gold? Well, it's a store of value, right? We know there's going to be inflation. Gold will be protecting me against that inflation. The problem for a long time, if we look at that last chart, is you're talking about 45 years it took for gold to get to a new inflation adjusted high. So that means people who bought it in 1980, it took until 2025 for gold to prove its worth, outpacing inflation. Now that's from the peak. So of course, not everyone bought it at the peak, but you could see from that 1980 peak to 2000, that was a massive, massive drawdown relative to inflation. Every single one of those years, the CPI was positive, right? So we had plenty of inflation, particularly in the 80s, definitely in the 90s, up to 2000, but you still had a massive, massive underperformance of gold. So it's definitely not as simple as, oh, gold's an inflation hedge. You know, inflation's high, gold is going to do well. There's many other factors driving it. And it reached a sentiment low point in the early 2000s. And today we're at a much, much different place. And you could see the inflation adjusted growth in gold over the past year. It's just absolutely stunning.
Incredible. Yeah. And this is a similar type chart, but I guess what's the different story here?
So if you're looking to value gold, no easy way or good way to do it. I would say if you believe that it's really a way to store value, then you should believe that it's going to keep up with inflation over time. It's, some people argue it'll outpace it by a little bit. We know for 40, 45 years it didn't do that. Now it's doing that. But this is just looking at gold versus the CPI, and the number doesn't matter. It's what matters here is looking at where we were in 1980. You can see 9 times inflation. Today we're at 15 times, and it took 45 years to get back to the new high. But we've seen as low as 1.5 times in the early 2000s, and we saw that in the mid 1970s before that parabolic move higher. So a lot of people are going to ask, well, can't this go to 20? Can it go to 30? Of course it can. But I would say if you're looking at it relative to inflation, inflation's 2.7%, 3% over the last year. You could argue it's even higher than that. Maybe it's 4%, 5%, whatever it is. This clearly isn't just an inflation story because gold is having its best year since 1979, and inflation last year wasn't as high as it was in 2022. That's when it hit 9% in the US, and gold was actually down that year in 2022. So there's obviously way more than just inflation here going on. But in terms of when do you want to buy gold, is it better to buy gold when it's underperformed inflation or outperformed inflation? Historically, if we look at the last 50 years, it's been mean reverting. So, but mean reverting, it could take decades for it to mean revert. But historically, you would have to say it's much better to buy gold when people think it's not a good inflation hedge than today when they think it's the best thing that's ever been created.
All right, let's take a look at our did the poll results already pop up? I don't know if anyone could see those, Charlie, if that was just you and I that could see them.
Look at that, S&P #1. Interesting.
All right.
But
Yeah, so I
gold,
don't know
gold number
actually if
two.
everyone can see this or if just you and I can, Charlie. But
Okay.
well, I'll just read the results from the poll just in case. But we had the top vote getter was the S&P with 40% of votes. We had gold not too far behind with 31%, Bitcoin with 26% of the vote, and then the true bears out there, 4% of our attendees here said cash would be the top performing asset type.
Yeah. So looking at this chart right here, I think it's just fascinating. We had the first Bitcoin ETF come out in January 2024. A lot of people, individual investors, other people clamoring to get into Bitcoin who didn't own it, in its pure form. They were waiting for the ETF. They thought, okay, this is the time, and it's done reasonably well. It's up 90% since it came out in January 2024, 2 years ago. I think the fascinating thing is after the recent move higher in gold and move lower in Bitcoin, the gold ETF is actually outperforming it. It's actually up 144%. And the Mag 7 ETF is even outperforming the Bitcoin ETF. So I don't like in terms of sentiment, the Bitcoin sentiment was very strong, obviously, up until a few months ago. Now we've seen the complete reversal. What's fascinating to me, though, Caleb, is many of that stuff in terms of the narratives to explain the rise in gold, we could have applied that to Bitcoin before it peaked last October. And now it's just kind of forgotten about because it lost that last factor, it lost the momentum. So very quickly, narratives were relying on, and not to say that Bitcoin won't come back, and that maybe this chart will look different a year from now. It certainly will look different, but maybe it'll reverse again with Bitcoin beating gold. But it's just fascinating to me that the boring old gold ETF that's been out there forever and is only recently, just saw last month we saw more inflows into the gold ETFs than we've ever seen in history. Like the gold ETF goes back to 2004, so 22 years. This is the most inflows we see. Not surprising after the move higher.
Right. And it's funny you talk about gold being the boring old ETF, and I think we historically have always thought of gold as being kind of an uninteresting asset class, right? Something that's a little bit boring. I feel like it's kind of cool. Like, gold is we're hearing more younger investors talking about putting gold in their portfolio, and maybe similar to some of the conversations we had around Bitcoin and some of the crypto assets years ago. But certainly been an interesting just change in the paradigm.
Yeah, as prices change, there's nothing more important to the narrative than the price, right? So whatever gold does from here, that'll be that drive what the narrative is going to be.
Yeah. All right. Well, let's jump into our last section here and look at most important charts to watch in 2026. And this first one, this comes fresh off of what was it, Trump's speech over at Davos around the improving deficit, right, and how it's so much better than it was, a year or two ago.
Yeah, you have to be very careful in looking at this type of chart and making projections, because I would say if we look at 2025 as a whole, we still have 2 more months of data we need in terms of the trade deficit. Through the first 10 months, the trade deficit actually rose. It's actually higher in the first 10 months than it was in the first 10 months of 2024, which means that all we saw in 2025, Caleb, was a massive front running of the tariffs in January, February, and March of 2025 because they knew the rate's going to go up. I'm going to load up on my inventories. I'm not going to pay that higher rate. I'd rather just buy it now. They did to record amounts. And then we saw the reversal of that after the fact. In October, we had a very low number in terms of the trade deficit, and lowest we've seen since 2009 for any particular month. And people are kind of projecting that into the future and not just kind of ignoring the first few months in terms of, well, they're working off those inventories. We won't know the true trade deficit, the true trade picture, I think, for a few more months. So when those U.S. corporations have to replenish those inventories, well, then they're going to have to make a decision, right? How much do they buy? When do they buy it? Do we have more certainty now in terms of it? And that's going to then be a truer picture than what we saw in 2025. And that's also the case in terms of prices, because there's a big debate now. Well, how much did it increase prices? Some people are saying nothing. Some people are saying a good amount. It's just hidden within in the CPI. But wherever you fall on that, I think you have to acknowledge that until these companies replenish their inventories, you won't know how much they're going to push through. So we could certainly see more price increases coming in 2026 in terms of these tariff rates, because someone has to pay the tax, right? It's $30 billion a month, so the federal government is getting revenue out of that. But the question is, what's the breakdown going to be? Who is going to be the seller, the buyer, the consumer? It's probably going to be a little bit of all of those. But to say that it won't have any impact on prices, I'm doubtful of that.
And you're saying that impact hasn't happened yet necessarily.
I don't think so. I think a company's going to wait as long as they can to push it through. And the bigger the company, the more that I think that's true. They'd rather take a hit to margin in the short run to keep their customers, and then just gradually push it through. So it might take a few years even to see it. But there's also the fact that we don't have certainty still over tariffs, right? The Supreme Court still has to rule on it. They could invalidate some of them. We know every day there's a new headline. South Korea, right? We're going to raise it. The situation with Greenland, they were going to raise it significantly. Then, 2 days later, they pulled it back. So there's still a lot of uncertainty where this rate is going to ultimately settle in on.
All right, next chart. Earnings. Will earnings live up to high expectations?
Yeah, this is going to be huge in terms of sentiment. We know valuations are high. Historically, U.S. highest CAPE ratio since 2000. The bulls will tell you that's because earnings growth is coming, very strong earnings growth, and the expectation is mid-teens or high teens. So we're talking about S&P Dow Jones is predicting 18% earnings growth for the S&P. That's triple the historical average of around 6%. If that were to happen, Caleb, then we have a totally different situation in terms of where valuations are today. You could say, you know, it's somewhat justified because you're going to have just 3 years of earnings growth pulled into 1 year.
Sure.
I'm doubtful because usually this number starts out high and falls throughout the year. I'm doubtful we're going to hit that number. It's not impossible, but this will be something for equity investors really to focus on. Are expectations too high? Is the reality going to be lower? Of course, a lot of this expectation is in terms of big tech continuing to have enormous growth and AI really pushing up not just big tech, but all companies in terms of their efficiency, their profitability, and everything else.
Yeah. Well, we don't have to wait too long to see, the first round here.
Yeah,
Um,
this week we got first tech earnings. The bank earnings came out. They were all very strong.
all right, next chart, right? It seems like everybody's just keeping their job. Nobody's moving.
Yeah,
Employment
this
staying
I've called
strong,
this
but
the most confusing labor market in history. Certainly the most confusing I've ever seen, and people are calling it the low hire, low fire labor market. That seems to be pretty accurate here. So last 3 months we have a decline in non-farm payrolls, and if you look back the last 70 years, every time you have a decline for a few months, you tend to be in a recession already. And so this time's already different in that we're not in a recession. We're clearly not in a recession. We're going to have a positive growth rate in the fourth quarter, but we're seeing labor market weakness or a slowdown in terms of hiring, but we're not seeing it on the flip side. So companies have been reluctant to hire new workers, but they're not yet doing big layoffs, and we can see that in the initial jobless claims number, which is lowest levels in 2 years, or about 200,000 here. It's a 4-week moving average. So in every recession, Caleb, you look at the initial jobless claims number. What is it doing? It's moving up and to the right pretty steadily. And so this is just a confusing labor market. It's
yeah,
it's kind of reached a
Charlie, is it
new
true?
level of supply and demand. Big reason for that is immigration in terms of big reduction. But there's other factors I think at play here too, and we'll see if the status quo continues, or we're going to see hiring kind of resume and get to, I don't know, just a lower level. So not 150, 200,000 jobs from maybe 50 to 100. We'll see if the last few months of 2025 were just an outlier and we're gonna start gaining jobs again. Hopefully that's the case.
Yeah. Do you see AI playing a big role here too, Charlie? Um,
Potentially it could. Like if you dig into the numbers and the data, we're not seeing it yet in terms of layoffs, right? Is this the reason why they're reluctant to add new workers, though? I think it's harder to say. That certainly would make some sense if like they're already thinking about that, and can they hold off and can they do more of what they have? Companies will put off hiring until they have to, right? They're trying to maximize profitability. So if they have this new tool that's making existing workers more efficient, and certainly wouldn't be unreasonable to think that they don't need as many new workers. So I think the jury's still out in terms of, I know that's the big fear that AI is
yeah.
going to lead to huge jobs disruption in the long run. I'm not in the camp that it's going to be terrible, just like every other technological wave. It'll just change the job that we're doing. It won't eliminate all jobs, but in the short run, that transition, of course, is going to be painful for some, great for others. I think the big lesson, if you're watching this for everyone, is figure out how to use it and to improve in your everyday job, whatever you're doing. You're going to be able to use it, and uh, whoever can use it better is going to be more valuable.
Agreed. All right. Interesting chart, right? Home prices, something we've been hearing a lot about as well. Are you implying they're already down?
We're getting close, about 1% year over year increase here. Now, this is lagging data from Case-Shiller, but we're getting closer. If you look at real-time indexes, we're about flat on a year-over-year basis. Many areas like Florida and Texas are down year over year, 5%, 10%. You look at different areas. So what we're seeing, Caleb, is a normalization finally from what I've been calling the most unaffordable housing market in history. And now we have a situation where sellers are outnumbering buyers, according to Redfin, by a record amount. And they've been tracking this for the last 15 years. So they're saying this is the most they've seen in terms of the spread. And absent outside interference or government intervention or the Fed starting to buy mortgage bonds again, absent that, I think home prices are either going to be flat or they'll be down the next few years. Certainly relative to inflation, there's going to be a mean reversion. It's just a question of when that's going to happen. There's no justification for home prices to continue to outpace inflation the way they have in the last decade, which is a record amount, even more than the last housing bubble. So there's two sides of this. For younger people who haven't bought their first home, they're going to say, this is great news. People existing homes, they're not going to be as happy. Their home price might be flat for a few years, but ultimately for the economy, for a lot of different reasons, we need home prices to be more affordable. So I'm hopeful that we let supply and demand do its magic and we don't try to interfere and stop what should happen, which is an overvalued housing market from normalizing.
Charlie, you think that affordability though comes from lower prices, not lower mortgage rates?
I think it should. I think because if it came from lower mortgage rates in terms of a lot of, we're going to give 50-year mortgages. We're going to have the Fannie and Freddie buy mortgage bonds to drive them lower. You could play those games, but all that will do is what created the crisis in the first place. That's going to create artificial demand. It's going to drive up prices. It might be good for that person who can get that low mortgage rate, but what about the next person, the person after that? So all of those interventions, all of those goals of trying to help the housing market, they're not helpful in terms of affordability. They're actually doing more harm than good. Anytime you subsidize a good, you drive up its costs. And even though the intentions might be good in terms of we need to make things more affordable, yeah, we do. But the best way you can do that is for let prices to come down, not try to, interfere with the natural rate of mortgages. The natural rate of mortgages should be much, much higher than where it is today. If you didn't have a government backstop for 70% of the mortgage market, you wouldn't be getting a 6% mortgage. You'd be getting much higher mortgage rate, and prices would come down to reflect that.
All right, I think we've got two left. This one's looking at credit spreads, right? So why is I guess, why are these credit spreads so narrow? Why is there such a low premium on higher risk debt?
It's more optimism than I've seen since, well, really 2007 in terms of the credit markets, where investors are essentially betting today that we're not going to see a default cycle ever again. You wouldn't be accepting this low of a spread for these credits that are pretty risky if you thought that we were going to have a recession, we're going to have defaults go up. So 2.6% above treasuries for high yield bonds. Historically, we've only seen that a few other times. Hasn't lasted very long. Can it go lower? Yeah, it can get tighter. Maybe we'll break the lows that we saw in 2007. But this is another way, a flip way of looking, Kayla. I would say the equity markets, you look at valuation ratios. In the credit markets, you look at credit spreads. And pretty much you can't get much more optimistic than this in terms of the credit markets. Now, this is a good thing to say, like, we're not in a recession, right? Certainly, you wouldn't see credit spreads this tight if there was economic weakness, and on a short-term indication basis, this is a good sign. But in terms of investor risk appetite, to me, this is a warning sign to say they're really not pricing in any type of risk in terms of the credit markets. You're not being compensated for taking this additional risk. So people are reaching for yield, probably on the bet, Caleb, that the Fed's going to keep cutting interest rates, rates are going to go lower. There's going to be pressure on the Fed to cut interest rates, so I should lock in higher yields now, but they're not taking in that default risk into account because it's been so long. Let's be honest, it's been a long time since we had a real economic recession and default cycle. You got to go back to the global financial crisis. So since 2009, we're in 2026, right? So it's been so long since investors have really been burned by taking that risk that they've simply forgotten that it can happen.
Yeah, yeah. It's ironic to think that rates are going to go down, and that's why you should lock in your higher yield. But usually, when rates are going down, that's not a great sign for some of these higher yield, higher risk bonds and
Yeah,
assets.
well, it depends why they're going down, right? Because normally, if they're going down rapidly and the Fed's cutting interest rates, usually there's an element, not this time, but usually there's an element of risk of recession. And that's really when you see defaults pick up and spreads widen, right?
All right, our last chart.
Yes.
And I think it's one of your favorite charts, right? This is
Yeah.
why are people happy?
Most important chart for an economy. You want to see this thing in positive territory. It has been 31 consecutive months where wages are outpacing, I have to say this clearly here, reported inflation. So just the CPI, 31 consecutive months on a year over year basis. That's fantastic news because this is what increases your purchasing power. This is what increases your prosperity over time. Is your wage, what you're earning every single month is going up more than the things that you are buying, right? And before this, we had 25 consecutive months where it was the opposite situation. People were losing purchasing power. They weren't keeping pace with inflation. And when people ask me, Charlie, why are you so against the Fed easing here? Can't you just get on board? We should go. This is why I want to hold the line. I don't want to see inflation go back up. I want to see this prosperity continue. We're in a good place. Let's not risk having this go in the opposite direction by creating another wave of inflation. So if there were no cost to cutting interest rates and easing money and printing money, we should do it all the time. But clearly, there's a cost. And we saw the cost for 2 years. I don't want to go back to that. I want to stay in this range. Hopefully, it stays here. And Caleb, you and I were talking about this yesterday. What's fascinating is if you looked at consumer sentiment, you would never know this is the case. Consumer sentiment last year hit, record low. If you look at University of Michigan, persistently low. We have a stock market all-time high. You have the economy still in expansion. You have a lot of positive things going on, but the consumer is very negative. But the question has been why are they still spending? Why is retail sales still going up? Why is the contribution to GDP, the U.S. consumer 70% of the economy, why is that still growing? Well, it's because people are still employed and they're still making money and they're actually making more money than prices are increasing. And that's a very good thing. So I hope this is at the end of this year when we talk, I hope this chart's still above the zero line and strongly above it.
All right. Uh, Great. Well, that's the end of our prepared content. So, Charlie, thanks as usual. Are you good to take a couple questions at a
Yeah,
time?
let's do it.
All right. First one, I think it's a good one. So, we talked about the Fed and the likely that we're going to see some cuts when we get a new chairperson in. If we do see the Fed cut, but inflation does stay sticky, right? So we see a rate of cuts when inflation is being pretty persistent. Do you like bonds or gold or something else as a better way to protect your investments?
So the scenario is the Fed cuts rates, let's say a few more times down to 3%, but inflation stays where it is or it goes up? It goes up from here?
Uh, let's say it goes up.
Okay. Well, it's going to be interesting because if that were to happen, absent QE where the Fed is going out and buying longer term securities, which we didn't talk about, but I think that's probably going to be part of the pressure with the new Fed chair. I think they're going to want to do that. But absent that, bonds will be in a difficult situation there because you're likely to see longer term yields rise. And the interesting thing about the Fed interest rate cuts is they've cut 175 basis points and the 10-year and 30-year yield have risen. So the 30-year yield was below 4% when the Fed started cutting rates in September 2024. Now it's above 4.8%. So the bond market, to me, sending a clearer message. The Fed isn't getting the message, but the bond market's saying, You may be done with inflation, but inflation isn't done with you, essentially. So bonds historically, Caleb, have done very good during Fed rate cutting cycles, but this has been they've done pretty good over the past years, but this has been unusual because we've seen the long end rise. Really, we haven't seen that before in the Fed cutting interest rates. So in terms of gold, I'll give you my standard answer. I have no idea, right? Because yes, you would think gold would do well in that scenario because there's still inflation. The Fed is ignoring it. Gold has loved that so far. It'll continue to love it, but how much of what we've seen in the past 2 years is anticipating that and appreciating that? And I think it's all in the short run, given the gains that we talked about, it's all going to be momentum. And when that momentum flips, it's going to be violent, right? You're not, we talked about stocks don't move in a straight line. Obviously, neither does gold. So be prepared for volatility there.
All right. See, just looking through a couple more questions here.
Yeah.
I guess so. One question around, we talked about that last chart, the growth in hourly wages, on an inflation adjusted basis. And, I guess the question is this hiding a, discrepancy between winners and losers? And Charlie, again, yesterday we talked about this kind of K-shaped, phenomena that people are talking about where you've got, some people winning and some people losing as opposed to kind of this rising tide lifting all ships. So there's maybe just, what's your take on that? Is that the real scenario we're in?
I think that's a fair critique, although we've seen pretty good wage growth in lower income deciles, right? So in the past 5 years, we've probably seen stronger wage growth there than upper income deciles. The issue, Caleb, has been, and it will always be the case, that inflation and cumulative inflation is always going to hit people on the lower income spectrum harder, right? It's just math. As a percentage of their income, they're spending more on groceries, on gasoline prices, on everything, right, than someone who's making hundreds of millions of dollars a year doesn't care, right? The prices could go up exponentially, and that person's not going to be impacted, right? So inflation's a tax on everyone, but it's a much bigger tax on the poor. It's a hidden tax. It's a terrible tax. I don't like it. I don't agree with it. I don't agree with the policy that we're pursuing here in terms of trying to create more of it. So definitely that's been the case, and we've seen as a share of spending, we've seen higher income groups grow and grow over the past few years. So as this cumulative inflation has built up, we've seen a bigger share of consumption come from higher income people. It's not just the income that matters there, Caleb. It matters the asset price inflation that's come with it. So who's more likely to own a lot of stocks, housing, other assets, gold, any Bitcoin, anything? It's going to be wealthier people, and they've benefited from really this debasement trade, debasing the dollar. And who's been hurt? People who don't own assets, right? They're just relying on their income. Perhaps they're living paycheck to paycheck. That's this inflation is the worst thing for that segment.
Yeah.
So
Probably higher rates, though, you can make the same argument, though, right? Those higher rates also affect those individuals more than they do people who don't necessarily have to borrow money when conditions don't make it attractive.
yeah, so you're saying credit card rates and other stuff. Yeah, for sure. Nothing is universal, but I would argue those higher rates would disincentivize them from using credit cards and trying to get off there. And if they had a low interest rate, maybe they would borrow more. So I'm not in favor of for many reasons the new policy things that are being proposed in terms of capping credit card rates and so on. I just think let the market determine where interest rates should be, and better things will happen for everyone. And if we exercise fiscal discipline in the same manner that most households are doing themselves in terms of trying to balance a budget, not spending crazy amounts today, and borrowing from the future to spend more today, I think that would be a better situation for everyone involved, but especially people on the lower income spectrum. So you just have this big divide, here. I'm not saying that it's an easy solution, but you shouldn't be managing monetary policy to try to create inflation that will be helpful for the 1% or 0.1% to the detriment of the people that are really struggling. It's just it's not a good thing.
All right, let's do one more.
Yeah.
So we talked about, some of the charts you'll be looking at as the year progresses. How closely are you going to be watching the Supreme Court ruling on the tariff situation, and how big of an impact do you think that will have on financial markets when that all gets decided?
Yeah, I'll definitely be watching it. I'm I, I think that the market's probably pricing in some type of pullback in terms of the tariffs, but there's a lot of uncertainty there because let's say the Supreme Court invalidates some of it, well then they could come out with a different thing that they're using to justify the tariffs, and then that's going to be another court battle in the future. So it's not clear cut. The Supreme Court says, okay, you overstepped. It's not the emergency that you're saying it is, so you can't use it under that act. You have to do something different. I think they'll try to find something different. I don't think they're going to abandon the policy, but um, I think it's just there's so much tariff uncertainty. But what we learned, Caleb, in 2025 and again so far this year is that there's no such thing as permanence in terms of these tariffs. The minute like the market is showing weakness, the bond market is showing rise in yields, the administration, someone within that, perhaps it's Bessent, he's definitely talked about the market impact. Someone's saying you got to pull back from this rhetoric. So the most extreme scenario we've kind of taken off the table from last April, and now we're just in a range of negotiations. And I think ultimately, if it proves to be bad, they'll pull it back because politicians want to get reelected. They're not going to keep these things if it's causing harm in terms of the economy and anything else. So there's no permanence to this. Whoever the next president is going to have their own ideas about tariffs. So even if they stay in place, let's say for the next few years, it's going to be in pretty short order that it's going to be rolled back. So I think what a lot of people say, well, why are the equity markets doing so well in spite of all of that? It's very simple. We had 13% earnings growth last year, and if people are projecting, mid to high teens in terms of earnings growth for this year, so there's many other factors. AI is just one of them that are driving up the earnings of corporations and the tariffs. Maybe they'll put a dent in that ultimately, or maybe they would have been higher the earnings, but they were still pretty good. So that's all the equity investors care about in the long run is are my earnings of my companies going to go up, and what am I projecting for future earnings? And if that's positive, it can ignore a lot of things that look, there's so many moving parts to tariffs, Caleb. You and I could talk for 2 hours about all the different scenarios and who it helps, who it hurts, and what are the risks, what are the potential benefits. But none of it's permanent. And the market is kind of figuring that out time and time again here. With each time it sells off, the sell off seems to be smaller. And then there's ultimately, within days or hours, there's a pullback. So the taco trade was the winning trade of 2025. So far in 2026, it's already played out again. Will that continue? I have no idea. So there's a non-answer for you on tariffs
Yeah.
because it's
Well,
such a complex topic. It would be its own show for you and I to really dig deep on it. And even then, we'd have to end with all of this could be reversed in an instant.
right. Right. Imagine that.
Yeah. All right. I
All
could
right.
imagine. Yeah.
Well, Charlie, thank you. You gave us a little bit extra time here, and I, appreciate it. Always learn a ton talking to you. Look forward to hopefully doing this again soon, and keeping an eye on several trends that you pointed out to us, and obviously we'll be looking for your updates as well.
Awesome. Thank you, Caleb. Always fun. And thank you, everyone, for joining us today.
Yeah, thank you, everyone. Take care.